Hi folks, Scott here, and this is the wrap for Thursday, October 3rd. So this is a daily chart of the S&P 500 cash index. It's the tracking index for the S&P. Has the most accurate closing prices, so it's the most helpful for using moving averages and so on. And it's not real helpful on opening prices or gaps per se. In fact, they're a little skewed. You want to use a regular chart, whatever instrument you're trading, to see the gap set to the proper regular trading hours. But you can see right now the market's still going live. It's a little bit before the close. I'm doing this wrap a little bit early because I have to do a webinar. We definitely have a low, and it's looking like we're going to have a low close, specifically a 15, I think it's an 18-day low, but I'm going to call it a 15-day low going into a Friday when above the 200-day moving average. I thought this would be an interesting pattern to test. A 15-day low preceding a gap on a Friday above the 200-day moving average. Go to Gap Trader. Special ends on this Sunday, by the way. It's on our website if interested in learning more. And there you go. 2-to-1 odds of gapping up on tomorrow based upon this one simple pattern. And it's pretty good using an end of the day stop. It's actually looked fantastic, right? Decent sized winners. Never had a loser on the downside. 9 for 9, and up gaps 15 of 20. So why is that? I don't know. It just tells you that tomorrow's not likely to be the day that the market breaks down, at least not in the morning before it fills its gaps. That's the way I think about it. And that's all I really care about. What happens after it fills the gap is not as important, even though that information can be helpful for range trades. But for my bread and butter, it's all about the gap, and this is a good nugget going in tomorrow. Now, as always, I will rerun these numbers using MTG stop parameters and share that with our folks in my pre-market comments to confirm the tradability of these setups, meaning whether or not MTG stops get hit before the gaps fill or not on average. Alright, let's look at what today showed. Today was a little tricky, I'll admit. Actually, it really wasn't that tricky, but as always, I do a lot of work to confirm the setup. Let me show you my analysis and thought process for this morning. I'm very conservative and redundant and comprehensive, whatever word intense you want to use, but it works for me. Alright, so this was the worksheet posted last night. This is now fully automated, like our guides, and it's posted at 6:15 Eastern time each night, auto-magically, as I like to say. Today we had gaps, we had very large closing variance. That means the futures actually sold off quite a bit after 4 o'clock yesterday, several points. So it resulted in a little bit of a disparity there for these gaps, meaning we had some gaps up in the futures. I think all of the ETFs gapped down. Some of the futures gapped up, some gapped down. So you'll have to look at this. Anything gapping up was attractive. Anything gapping down between the close and the low was just sort of neutral overall. You had to look at the individual gap guides, because this is just the summation of the guides for each of the 8 indices. Unfilled down gap yesterday is actually a big positive for gaps in either direction. After a false up day, favored up gaps but not down gaps tends to pretend a little weakness. I'm going to show you the gap guides, and specifically on the futures, look at the UC, well, really dependent on the market. In fact, I'll tell them each one. The ES opened down by like a tick or two, 1 tick I believe, in the UCO zone, which was right at my criteria for fading. Good numbers, weighted average for 61.3, but wasn't enough of a gap to trade. Plus, it wasn't confirmed by the other markets. The YM didn't look quite as good, but not bad. Nasdaq actually gapped up in the UHC zone, so you could have gotten a small win there if there was a small gap. And same with the Russell, gapped up in the higher probability zone. All of the ETFs gapped down, if I'm pretty sure. UCO zone looked pretty good in the spider, right? Diamond's just neutral though. Qs look good and neutral in the Russell. And you had that one risk factor I mentioned before. In fact, look at my pre-market comments. Last night's wrap showed it was a little bit neutral, this unfilled gap and a false up day, just a neutral setup historically. And this is an interesting pattern here after a 5-day low close, correction, when closing not at a 5-day low close nor a 5-day high close, so just in between and below the 10 and day but above the 200-day moving averages. Up gaps have been problematic, but down gaps have been neutral to weak. Up gaps actually look a little bit worse, so I was a little bit concerned for any up gap, but that was the only concern really, quite frankly, for an up gap. So bottom line for me, guys, were neutral to slightly attractive for fading down gaps, and attractive overall if opening up in the UHC zone. And read my key concerns there. Large closing variance. Oh, by the way, so 920, and I posted all this without this sentence here. Key concerns, they include large closing variance between futures and ETFs. I missed that on my laptop when I was working on my analysis this morning downstairs, so my apologies. I updated it in 923. That was the only thing I updated right there. Because I originally said I was short an up gap if it was as long as a point of opportunity, which would have worked, but you would have been at a gap down in the ETFs, and that's why I don't trade those small gaps in opposing directions. So bottom line is there was just no trade for me in either direction. And for anyone that was tempted by the ETFs, hopefully you took heed with my forewarning that it wasn't a great setup. In fact, that's what I said, right? I said fading historically similar down gaps, though not terrible, is not showing a clear edge of profit expectancy. Anytime I say something like that, it's just a little bit more of a hit or miss. Yes, there'll be some winners, but in general, you're going to regret taking them over the long term. You consistently, at most, no matter what other techniques you're using, at most you're probably going to end up break even at best. Getting some selling pressure into the close. That could escalate here quite a bit. Let me show what I mean. Go to the 5-minute futures. See, we're back below the lows. In fact, so now I'm here. So I didn't do any gap trades. For time's sake, I'm not going to show you, but the data slightly favors, right at it, is about half the indices favor the low breakout of the first hour range, nothing in the 15-minute range. I did a delayed entry on the first hour low range breakout and a little bit smaller position size. So technically, between the two, I just called it a discretionary trade based on, in part, the low range data. That was the primary reason, but market was weak. We were below the lows of not only yesterday but 2 days ago. That's the low there. And I went short on a break of that low right there. Nope, actually it was, yeah, that was the wick that got me short. Took a little bit of heat. Had a 4-point stop, 7-point target. Unfortunately, I had to run out for a couple hours. Market was banging on 66 area at the time. A 7-point target was just my read on the market. So where confluence areas were, I felt there was a good chance to run some stops down here, and we did. Unfortunately, I bailed on it, took my 4 points, so I didn't have to worry about it while I was out and about, and cost me 3 points on the trade. But it was a nice discretionary trade based in large part on the first hour low breakout. So that was my only correction. I did one other trade. I went long on a bounces confluent, got +2, and I did not tighten my stop for reasons basically because I felt like if I got stopped out, then the market was truly weak, which is what happened. Otherwise, I had a pretty good chance of getting +5 or more. Got -3 on that, so I lost technically an average of -2 ticks on that trade, but more than made up for it on +4 over here. So small winning day, and good call to not trade the gap, because if you traded the gap in the ETFs, you would have been disappointed because you would have been stopped out. See, pretty much sold off the whole time. None of these gaps actually Q's may have filled, but nothing else did. So that was my day, and that is the wrap for Thursday, October 3rd. Have a good one.